The 30-year supercycle is dead. The shockwaves of the budget are ripping apart investments. Residential property is in freefall, and the system our parents and grandparents relied on is being dismantled right in front of us. It's the biggest change since John Howard's changes in the 1990s. Banks have reacted quickly. Housing investor loan applications have been sliced up by 30%. That means a property investor who was approved for $1.1 million before is now only approved for $800,000. The good news? This chaos is giving smart investors an opportunity. Hi, I'm Anita Yao. I have 20 years of experience in the industry, both as a commercial buyer's agent, helping investors navigate the market, a licensed construction and property lawyer, and a property investor myself. So, where should property investors be putting their money? Are there still assets that can provide stable returns? Today, I'm going to take you through how the budget has changed the property landscape, what the end of the supercycle really means, and why it's time to pivot to commercial real estate. Plus, stick around to the end where I'll show you why now is a bigger opportunity than COVID was, and why you need to act in the next 3 months to take full advantage of this opportunistic time. Let's jump into it. A new world. First, a little reminder about how the federal government's bombshell budget has changed the property market. The big target was residential property investment, and the two most important changes were about negative gearing and capital gains tax. Negative gearing can now only be used on new builds and commercial properties. Interestingly, while the narrative from the government was to unlock more housing for younger people, about 1.1 million Australians own negatively geared rental properties, which make up about half of all individual property investors. Then there are the capital gains tax changes. Before, there was a 50% discount on assets held for more than a year. Now there are new 30% minimum tax, plus it's adjusted for inflation. Plus, if you are a residential investor using a self-managed super fund, there are even more changes. The date to keep in mind is Sunday, August the 9th this year. After that, you won't be able to take out a limited recourse borrowing arrangement. In a nutshell, the tax changes mean you cannot rely on negative gearing or residential property anymore. It's the end of an investment that has been a staple of wealth building for generations, the 30-year supercycle. Number 2, is the 30-year supercycle dead? You might have seen the term 30-year supercycle popping up in the media, especially people talking about how it's ending. This is a big deal. The residential real estate market is over 12 trillion. It contributes about 10% of Australia's GDP and employs more people than mining, manufacturing, and finance combined. And for decades, it's been built on the idea of a supercycle. But hold on, what exactly is a supercycle? Usually, an economy alternates between phases of expansion and contraction. These are normal business cycles that investors watch out for to know when to buy and sell. But a supercycle works outside of those phases. It's a long-term imbalance between supply and demand, with strong demand and high prices. As Ray White, chief economist, they describe, unlike regular housing cycles driven by interest rates or market sentiment, a supercycle reflects deep structural changes in the property market that creates lasting imbalance between supply and demand. This structural shift has been reinforced by several decades of policy and financial change. From the 1980s through the 2000s, Australians experienced a significant expansion in borrowing capacity, financial deregulation, and looser lending standards, followed by prolonged decline in interest rates. Combined with tax incentives like the Howard government's 50% capital gains tax discount and negative gearing, this changed how Australians viewed residential property. It wasn't just housing anymore, it became a primary vehicle for long-term wealth creation. There was very little risk. Australian property has been a near-guaranteed moneymaker for decades, with 53% of Australians' wealth linked to property. But with the latest federal budget, this era may be coming to a grinding halt. At least, that's the opinion of some economists in the area. What we need to understand as investors is that policy changes this big were always going to reshape Australia's residential property market. The long-term growth cycle has been shaped by structural drivers, including expansion of borrowing capacity, falling interest rates, tax incentives, negative gearing, and 50% CGT discount, plus sustained investor demand. When governments materially alter this entire property ecosystem, we have to recognize that the fundamental structure for the last 30 years supercycle will change as well. This isn't just speculation or theory. It's actually already begun. One by one, the major banks have adjusted. They are now factoring the new reality of investors losing negative gearing benefits. Residential investors are having a tougher time getting loans. Borrowing capacities have dropped a whopping 20%. Some reports claim as much as 30%. What does this mean? An investor who qualified for $1 million loan before the changes are now only eligible for $770,000. Anecdotally, working with brokers, buyers, and everyone in between, I can tell you that everyone is reporting similar numbers. And the talk in the industry, in meeting rooms, across online forums, is all telling the same story. The supercycle is dead. So, what should property investors be doing instead? The answer is simple: commercial property. Why commercial property? There are a few myths about commercial property. That's only for older, incredibly rich investors, or that it's riskier than housing. I'm going to tell you why that's all completely wrong. Young people are getting smarter about investing. I see it all the time. And to be smart, you have to respond to the market. The massive tax changes are wiping out negative gearing and the CGT discount, and super fund loopholes for residential property investments are being closed. Most people think of commercial properties as this gigantic shopping centers worth tens of millions of dollars. But there are plenty of other options like smaller assets like retail, industrial units, and medical. This is why commercial property is heating up. The industry is already adapting. One new strategy is for business owners to buy up their business premises and pay the rent into their self-managed super fund, leaving them with an asset for many years to come. But it's not just business owners. Individual investors stand to gain just as much. According to Commonwealth Bank, 1 in 3 properties in commercial market are held by private investors, and this number is growing every day. So, what are the benefits of commercial property over residential? Let's have a look at the advantages of residential property side by side with commercial property. On the left in red, we have residential property. If you've ever rented before, you'll know that standard lease is 12 months and renters break leases all the time. On the right-hand side in green is commercial property. These leases run much longer, usually longer than 3 years and frequently up to 10 years. Then there's the rental agreement. Residential properties are usually fixed for the entire term by law to protect renters. In the commercial world, there are usually annual increases either linked to inflation, market value. Then there are outgoings, things like council rates, building insurance, management fees, and maintenance. Residential tenants almost never pay these, but business tenants leasing commercial property usually cover some of these and sometimes all of them. Most importantly, there's more money to be made. For residential, returns are typically between 2 to 4%. Commercial property can be double that. As of the first half of 2026, the office sector is sitting at 6.7% returns, the industrial sector at 7.4%, and retail is 9.4%. All accounts, commercial property is a better investment. This is especially true after residential property has come under attack. Experienced investors are already pivoting in this direction, but you still have an opportunity to get ahead. Every economic shock in the property cycle, like COVID in 2020 and the interest rate rises in 2022, investors usually take about 3 to 6 months to flood the market. You still have approximately a 3-month window to really use these insights before the market gets flooded. If you've been setting up a self-managed super fund to buy a residential property and have been impacted by the 9th of August 2026 limited recourse borrowing arrangement changes, don't assume your investment plans are over. Your super can still be used to purchase property, and your best bet is commercial property where borrowing remains available under the current rules. So, how do you make the shift? Well, you've come to the right place. My company, CRE Wealth, specializes in getting individual investors into high-yielding commercial property investments. You can lean on our expert knowledge in the commercial investing space. We have bought over 200 plus commercial properties for our clients, and our business is based on one-on-one personalized advice. You wouldn't go to an accountant to get your teeth cleaned. It's the same thing with commercial investing. If you want the most cutting-edge commercial insights, then you came to the right place. As a commercial buyer's agent and a property lawyer, I'm at the crossroads of this accelerating industry, and I can put my knowledge to work for you. Scroll down to the comment section of this video to set up a free assessment call with me. Otherwise, I'll see you in the next video for more property insights.